As big tech starts to see a downtrend, the Russell 2000 is seeing an uptick. And that's why today we are going to talk about 3 small cap stocks under $10 for investors to look at. Joining us with that list today is James Early with Curia Financial. James, thank you so much for joining us in studio today. We love having you here.
You don't have to twist my arm to get me to come to South Dakota, Bridget. I love being here.
Awesome. Well, we love having you in studio, and I'm excited about this list today. I know you like really solid companies. You are somebody who is a Warren Buffett person for sure. So we're looking at small cap names, but these all have strong fundamentals and are companies that you think have really strong growth potential.
Yeah, and you gave me a challenge with this actually, because I learned it's kind of hard to find good small caps, at least profitable small caps, trading for under $10. On one hand, the price communicates nothing, like it's kind of arbitrary, but on the other hand, it's sort of psychologically symbolic. Some companies either see their prices rise quickly, or they maybe do a reverse merger to approximate a good-looking company to keep their price above $10. So we're kind of looking for good companies who don't care about looking like good companies.
Yeah, I think that's interesting too. And I want to talk about, before we get into the 3 names you have for us today, that fundamental reason. I think our viewers really like this concept of looking at stocks under a certain dollar value, because the cost of entry is lower. For the retail community who maybe only has a few $100s this month that they want to invest, they can buy a lot more shares of a $9 a share company than a $200 or $2,000 a share company, which we see some of those sometimes. Talk about that fundamental thing in the market too for retail investors.
Well, let me stick in a public service announcement here, because these days you can buy fractional shares, which means you can buy 3.5 shares, or you could buy 0.5 or 0.3 of a share. So stock price is really kind of arbitrary, but still you have people looking for that. Like you said, people come in, especially newer investors, say, hey, I want to buy a stock under $10 because I feel rich. I can buy 10 shares rather than just 1/10 of a share of a much more expensive company. Again, I wanted to meet the challenge, but as an investor, my advice is don't anchor too much on that stock price.
Good information for our investors today. Again, we love to fit in a little bit of education along with this, so thank you for that. Let's talk a little bit about how the Russell 2000 has been performing. I think overall, we've seen a little uptick, especially recently.
Yeah, you had all this attention on the Mag 7 or the Mag 10 for the longest time. It was 40% of the S&P. It was scaring people how much in love the market was with that, and we've seen that pull back, and it's spread out across kind of the regular stock, which I love to see because I think it makes a healthier market. Russell 2000 is up pretty nicely over the past year, even a little bit over the past month. So the Mag 7's loss has been the Russell's gain.
Yeah, and that is why we are diving into these 3 names today. But I want to talk to investors who are really interested in these small cap stocks. I know James is going to talk a little bit more about why these micro cap, small cap stocks are some of the best growth opportunities for retail investors in particular. We'll get into that too. But one of those opportunities is in the energy sector, and this stock is under $2 right now. It's a stock that big oil has buried for about 50 years now, but it's something that has a major catalyst coming up in August. So the timing is huge on this stock. And again, it's a very small company today with a ton of growth potential in the near future. So if you want to check out that stock and get the detailed report, we have a special offer just for our MarketBeat viewers today. You can scan the QR code or get the link in the description to get that special offer and learn more about this tiny stock in the energy sector with a huge catalyst coming up in August. Just scan that special offer now. All right, James, let's get into the first stock that you were looking at as a small cap under $10 that you really like the fundamentals of the company.
Aviana Health, AVAH is the ticker, $9.49. This company provides home health care, usually to complicated or expensive cases. Medicare and Medicaid are about 91% of this company's revenue, and home health care is a growing market. It is substantially cheaper, Bridget, to serve a patient at home than to put them in a hospital where they're monitored with all these machines and expensive stuff. So this is a growing market. Insurance companies tend to like it. This company delivered 16% revenue growth the past year, and they upped their 2026 revenue guidance twice in the past year. So this is a company that's doing even better than the management expected.
Yeah, I think you see that in the earnings report. That's one thing that stuck out to me is this company seems to be doing really well, even just this last quarter.
Yeah. They're in 39 states, by the way, including an office right here in Sioux Falls. This is a company that to me could be buyout bait. A big insurance company, or maybe a bigger home healthcare company, or maybe even private equity could come up and say, hey, this is a tiny little company, about $2 billion market cap, $2.1 billion in revenue, so not that big. They could easily buy this company. So I wouldn't look for this as being like a massive home run, like up 10x in a year. It's not a semiconductor type of company, but it's probably going to be a modest market beater, and then maybe one day gets taken out.
Let's talk about the price action in the chart too, because you look up the chart on this one, it's already had over 120% run up in the last year. So it has been kind of a knockout stock. And I think sometimes our viewers look at stocks that have already had a run up and wonder, is now a time to be looking at this? So is now a time to be adding this, or is it a time to add it to the watch list and see if there's any further volatility? Because it has had some volatility.
Yeah, all these stocks, by the way, are watch list stocks in my view, meaning I'm not saying run out and buy Aviana Health. I'm saying it's definitely interesting enough to catch my eye. With a very small company, Bridget, I worry a lot less about 100% plus run up because these companies have so much ceiling, had so much room to run. The institutions really can't buy these tiny little companies. They will move the market too much. So this is the one area of the market, small caps and micro caps, where retail investors like you and me have a real advantage.
Yeah, and I think you see a lot of that movement in the healthcare companies. Not so much the traditional healthcare as this, but you think about biotech and other kinds of healthcare names that are in those tiny micro cap, small cap names that see so much movement and a lot of volatility for investors. So I want to talk about that with this one. Do you expect this name to see big swings, or is this one a little bit more steady than some of those riskier biotech kind of healthcare companies?
Within the healthcare bucket, this is definitely on the steadier end. This is just in-person home health care. You can't replace it. It's not something that AI can do. Biotech is going to be tremendously more volatile. Now, separately, I kind of like biotech too, because this was beaten down. We had this flood of biotech companies coming into the market in 2021, and the FDA only approves about 50 new treatments a year. And you had thousands of companies, so the math just wasn't working out. And that washout is mostly done. So yeah, if you want more risk, you can look at biotech later, but if you don't, and if you want to profit from healthcare, I would take a deeper look at Aviana Health.
All right, let's talk a little bit more about healthcare as a sector as a whole before we move on to the next name, which is in a totally different sector. The healthcare sector has been a little volatile, is how I want to say that. Some of the mega cap companies, even though United Healthcare had a very volatile last year. How do you think this sector as a whole is performing right now as far as investors being interested in the broader healthcare story?
Yeah, I think it's underperformed its potential in recent years. AI has taken all the attention, Mag 7, Mag 10, as we said at the start of the video, but step back, 18 to 19% of US GDP gets spent on healthcare. We spend a ton of money on healthcare. We have an aging population, lots of these baby boomers. The demographics are strongly in favor of healthcare. So this is a sector where maybe it hasn't looked great over the past 5 years, but to me, that's a reason to jump in, not to jump out.
Yeah, and I also think I had another guest on the show recently who talked about if there is an economic downturn of any kind, which sometimes in a midterm election year, investors are bracing for that. Healthcare is one area where people don't cut. You can't really cut your healthcare budget.
Yeah, you're not going to not get your hip replaced if you need it, right? I mean, maybe you got to wait a little bit, but in general, it's a pretty, we say, inelastic demand sector. I mean, people are going to pay for it and get it no matter what.
All right, a great first sector and first company to talk about. Let's move on to the second small cap you have for us, and this one's a different name in a different sector.
The second company is Genworth Financial, $9.24 a share, at least as of today. This is an insurance company that has two completely different buckets of insurance. By the way, it's about a $7 billion a year revenue company, a PE of 17, which is also below the S&P 500's PE. The first bucket is just under 82% of a company called Enact that provides private mortgage insurance. And PMI in the US is a market that's growing about 8% a year, which is a lot faster than GDP in general. It's a boring company, let's be honest, okay? Yeah. But boring companies pay the bills. And again, for this assignment you gave me, Bridget, I wanted to find profitable companies, and Genworth is profitable. The PMI business they have, or they're a holding company that owns 82% of this PMI company, 55% net profit margins. Now, if you're not a math person, if you're kind of new to investing, that is phenomenal, right? That is a blockbuster profit margin. That helps pay the bills for the second bucket, which is this horrible, awful legacy. It's a closed book. They're not writing new policies, but legacy book of long-term care insurance policies this company wrote in the 1990s and 2000s, and they massively underpriced these policies, and that's costing the company $300 to $400 million a year in cost. Now, eventually, that's going to run off. They'll be done. That's going to be over with. If you look at the chart, though, there's this really like amazing and frankly very ugly price movement a long time ago as that long-term care stuff happened. But then if you zoom in to the past 5 years, it's up and up and up and up because they spun off this PMI business. They still own most of it. They spun off part of it basically. That's been paying the bills. That's been working super well. So it's got a weird kind of complicated story, but as an investor, that's what I like. I'm drawn to complexity. I want to go into not a totally burning house, but like a little bit of an ugly house maybe. I don't want curb appeal. I want to find the house to be a little nicer inside than it looks on the outside. And Genworth Financial to me is a small cap that has that.
And what a pivot story to see that the difficulties they had on those original concept for the company, to see like it could have been headed towards bankruptcy until they had this great pivot story. You already explained it a little bit. You like complex companies, but companies that have had great pivots, are there examples and other examples where you've had a lot of success looking at companies that are in the middle of financial turmoil and they make a really smart pivot or smart move as a business that really pays off for the investor?
Yeah, it's a good question. Off the top of my head, I'm sure there have been. It's so rare, honestly, that it's hard for me. Usually pivots don't work. This one has provably worked for at least 5 years for Genworth. That's why I'm talking about it today. But usually when a company says, hey, we're making a pivot, GameStop would be an example of a successful pivot, at least successful so far. I don't like GameStop as an example because it's such a weird company that's kind of distorting the laws of the social science of economics. I don't think many companies can do what they did, but to be fair to them, Ryan Cohen came in and said, look, this is a dinky, dying business. I'm going to parlay this meme stock fame we have, and we're going to become a Bitcoin company. It's kind of silly. It shouldn't work too often in society, but it did work and he did it well. Now, I don't think he's going to have similar success with eBay. They don't want him to buy their company, but it was a pivot that worked out. This pivot from Genworth is a lot simpler. It's still within insurance, albeit a different type. I mean, this has already succeeded. We don't even need to talk about odds of success because it is already working for them. It is the majority of their business. They're making lots of money, 55% profit margin. I mean, you can't argue with a number like that.
Yeah, and their earnings report absolutely shows that, again, very successful for them. The stock story, I mean, they're steadily growing over the last 5 years. Like you said, I think this year it was up a little over 20%. So not tremendous growth. And that's the key question I have for this one is when you're talking about a mortgage insurance company, what kind of growth trajectory do we have here? Is it going to be slow and steady, consistent, 10 to 20% growth year over year? Or are we looking at potential bigger growth story as this company grows? Like how big is that market for growth?
I'd say medium to steady, so kind of like a fast turtle. Like I said, the PMI market itself is growing at 8% a year, so a better than average company, and let's pretend Genworth or Enact, which is actually the mortgage subsidiary it has, is better than average. You might see 10, 11, 12% growth, something like a little bit faster than average in the long run. It might be faster than that right now. It might kind of drop down to that level. So this is not going to be like a quadruple or a 10-bagger. If you want that, I mean, there are many unprofitable small cap stocks under $10 that you can gamble on. But again, for this video, I wanted to focus on the higher quality names. And there's a price in the market to quality, right? You got to give up some of that growth potential if you want to sleep at night. But for me, I think it makes sense because 60% of stocks in the US market lose money for investors and 40% go to zero. From 1924 till roughly 2023, I think almost 100 years, a professor at Arizona State University, Hank Bessenbinder, found that just 3.2% of US stocks accounted for 96, or actually all the gains, about 100% of the gains. In other words, most stocks aren't going to win for you. Most stocks are going to lose money. So when you're looking for smaller companies, you really got to prioritize financial strength, provenness of business model. For every winner, there are hundreds of losers.
Yeah, I think that's such sound advice. Again, there's a lot of education in this video today. I hope everyone is enjoying it. I want to talk a little bit about some potential risks for this company in insurance. And then you're talking about mortgage. How susceptible is this company to moves in interest rates or what might be happening with disasters or things like that? I'm just curious, like what other factors could potentially move this stock negative or positive?
It's a good question. I looked at the same thing, or I wondered the same thing when I was looking at this stock. At least by the price chart, they have moved relatively little as we've had rates rise and fall. And let's remember too, it's done fantastic over the past 5 years as interest rates have shot way up. I got a mortgage in 2021 at 3%. They doubled not long after that. So if this company can deliver these kind of results in that environment, in a rising rate environment, which is like the worst you can get when we're housing supply constrained, they're probably going to do even better if rates can come down a bit as more inventory opens up and more sales transactions can happen.
A quick note, I want to talk about too the broader insurance industry. What do you think about insurance as somebody who's always looking for those more, fundamentally strong companies? How do you like insurance and how is it performing right now?
Insurance is kind of a slow, steady, boring thing, which is why I like it. There's like a zero curb appeal. It's basically a pure math business. But Warren Buffett really trailblazed this idea of, hey, when you're an insurance company, you can invest the float and not just treasure. Float is the money you get before you have to pay out claims, right? There's usually a period. Unless you crash your car immediately, the company has your premium for a little while before they pay, and maybe they never pay it out. Hopefully they don't, right? They used to just invest it in treasuries. Warren Buffett said, I'm a good stock picker. I can use this to buy stocks. Other companies have since copied that, and that's basically made the insurance business more lucrative writ large. And there are different segments. There's specialty, there's reinsurance, which is kind of insuring the insurance companies against big disasters. I tend to like the specialty insurance companies a little bit more in general. A company like Markel, which is like a baby Berkshire based in Richmond, Virginia, that they're proud to copy Berkshire, basically. They provide kind of a weird niche specialty type. And their joke is, if you haven't heard of it, then we probably insure it. And that focus on a niche gives an insurance company pricing power. So as much as I like Genworth as a PMI company, we've all heard of PMI. We know it, like some weird type, specialty marine insurance or insurance for, skydiving, things like that. Usually they can charge even higher prices.
All right, really interesting look. And again, I love the focus on fundamentals. But another company that's been on a downtrend recently, but has a big turnaround story potential coming this August, is that energy stock I mentioned earlier in the show. Just a reminder to check out that special report with that tiny under $2 energy stock that most investors are not looking at right now, that really big oil is trying not to talk about right now and has a ton of potential. Scan that QR code or get the link in the description to get that special offer today and learn more about that $2 stock. It's an interesting catalyst and a really interesting growth story coming potentially this August. So take advantage of it now while you can. All right, James, let's get on to that third company that you were talking about today. And this stock in particular is different than the first two because unlike the first two we talked about, this one's on a bit of a downtrend right now.
Yeah, eGain is the company, EGAN is the ticker, $6.36 as we speak. This one, I just want to announce, be careful with this. This is a micro cap, $175 million market cap. These things can bounce around for really no reason at all, so do not load up on this one. Be cautious. This company was actually founded in 1997. This is a cockroach of a company, and then it's just stayed alive. Ashutosh Roy, Stanford MBA, who used to run a call center in India, made a customer relationship management software business, handles emails, customer databases. They did an IPO in 1999. The stock spiked after that, then it crashed. It crashed 99.97%. And you think, okay, they're dead, just like all these other, .com, whatever. They did a 20-to-1 reverse split so they could stay listed, and miraculously, they chugged along for literally decades, earning 80, 90 million a year in revenue. Not a ton of money, but enough, and they were profitable. Then AI came along, and they decided to repackage themselves as an AI customer company, which sounds like a gimmick at first until you realize, well, this is actually an area where AI could make a difference. And in fact, their customer retention rate, the non-AI is 101%, meaning customers actually buy a little bit more every year. The AI customer retention rate, and again, we don't have a ton of data because it's still new, it is 116%. So far, the data is showing that AI is actually working for them. The stock price has bounced around a lot. It was 15 earlier, about a year ago. Now it's 6 something. I think the market is trying to digest, is this really an AI play or not? A PE of 4 point something. The reason I like this, though, it's not a company that just bubbled up to try to capitalize on the AI trend where there's like nothing there underneath. This company has existed for basically 30 years and is profitable. So even if the AI stuff doesn't work out as well as they hope, there's still this kind of put option. There's this profitable base that's been around for 30 years and is probably not going anywhere. IRS is a client. LL Bean is a client. JP Morgan is a client. These are some legitimate enterprises that use their software.
Yeah, again, software is the key here, though. This is part of that software story. And I think that that is exactly what you see in the chart. You look at the chart and it follows every other software company that's been on a downtrend since the start of the year. So
Yep.
it's very much tracking along with the software apocalypse story that we've seen. But there's so much to this company with this AI switch as well that is it just a software story or is there something more to this? And I think it's the same argument we've seen many, many times. And that's, is AI a benefit to software companies versus a detriment to them? And so what's your take on that for this specific company?
So far, I mean, customer service is one of the most labor-intensive functions in an organization. I mean, it depends on the organization, but generally it's a ton of labor. So my personal bet, and the reason I'm talking about it today, Bridget, is that I think AI is more of a friend than a foe. But to be fair, the dynamic you mentioned is really like this motif, this archetype that's been plaguing the markets for the past year. We can't figure out, is AI friend or foe? And really, it kind of goes by the week or by the month. I mean, we've seen, I put my dad at a bunch of these AI companies that were, these software companies, excuse me, that were beaten down. And you've seen it too. These companies have gotten killed, these SaaS companies, which were darlings 3 or 4 or 5 years ago. Everybody wanted all in on SaaS. But you think sometimes they're so baked into the kind of the verticality of a company's business that I can't imagine companies just ripping them out. Even if the AI can replace 94% or 96%, that remaining 4% or 6% could be enough to derail a whole company's operation. So I think this SaaS beatdown is overdone. Now, again, for this company, eGain, there's an added dimension of just this is a small, kind of sketchy little company, and it's going to get tossed around by the waves to and fro. It's not just that SaaS story, but that's part of the story. You're very correct.
Yeah, I also think that that small factor that definitely moves the stock price more than some of the other software stories. But I think that I want to hone in on what you talked about with it being profitable. The last earnings report was incredibly impressive. Let's dive into that last quarter and how they had several quarters like that.
Yeah, they've been beating expectations for quite a while. And yes, 75% of the time, all companies, across all companies, the company beats expectations. The expectation is kind of a joke, but my point is, like a lot of the other SaaS plays, if you look, they've also beaten their expectations, beaten analyst expectations, or at least their own announcements. The fundamentals are there. And that's why I was drawn to this company, because as an investor, going back to this idea of running into the burning house, or at least the burning house that doesn't have, the house that doesn't have good curb appeal. Maybe a burning house is too scary for some investors, but you want to be doing something the market is not. That's basically how you make money. So when you see a company that the market is kind of punishing, but which the fundamentals are still strong for, at least I get interested.
Yeah, I want to go into a little bit more of what you said when you started talking about this company, and that's essentially don't bet the house, right?
Yeah.
Don't dive into this with a ton of capital. So what does that look like for you? What's a cautious approach to what you just said about, looking at companies that are a little bit of a burning house to get into them, but how much capital, what percentage of your investments go into a company like this that is a little bit of a riskier play?
Yeah, excellent question. There's never a definitive answer, and that's kind of the point. Academics have tried for 70 years to figure portfolio theory out, like how diversified should you be, how big. They can't, and they never will, because it's a social science. Rule of thumb, especially coming in, I don't like any position to be more than 1% of my portfolio, maybe 1.5%, 2% if I'm really, really happy with it. I have a lot of index funds as well. For something like this, I would make it even smaller than that, knowing that it could go to, I don't think it's going to go to zero, but it just could underperform. So yeah, don't bet the farm. I would say probably less than half of 1% for most people. But let me say this, Bridget. Warren Buffett has said that if he were starting today with just $1 million, he said, I think I could get 50% returns per year. In fact, I know I could. And he would do that in microcaps, because that's where the average investor has the very biggest advantage, even more so than small caps, because there are some big investors, some smaller hedge funds that can buy the small caps, but basically only the retail investors can buy the microcaps. But you got to do your homework.
Homework for sure. And that's exactly what we did today. James, thank you so much for diving into that and researching all these companies for us. I love the list that you came up with today. Different than what we normally have, for sure. Let me know what you think about these names in the comments, and also looking at the profitability of small caps when you're looking in this market. I'd love to hear your take on that too. If you are interested in other small caps or other low cost of entry stocks, we have plenty of videos very similar to this topic. Make sure to watch this most recent one here.